Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
The bigger picture for us hasn't really changed. We think new 2010 lows will appear at some point over the next several months, and that a move sub S&P 1000 and maybe even sub 950 will occur. We will continue to monitor the Russell 2000 for a potential structural breakdown, with warning flags now waving vehemently on closes under 625. It's Tuesday, June 22nd, 2010, and today's guest is Rick Bensignor. Rick Bensignor is Chief Market Strategist at Execution Noble, LLC. He was previously Chief Market Strategist at Morgan Stanley Principal Strategies, responsible for providing the firm's proprietary traders with strategic investment and tactical trading ideas. Prior to that, Bensignor was the corporation's institutional investor-ranked Chief Technical Strategist, overseeing the firm's banner technical research product. He was formerly the head of technical analysis, futures, and commodities at Bloomberg, where he was responsible for product development, sales, and marketing of those applications. Before that, he was Morgan Stanley's commodities technical strategist and head of the institutional commodities sales desk, which followed his 12-year trading career as a broker and independent trader on the floor of several New York futures exchanges. Rick Bensignor, welcome to the program.
Well, thanks, Ed.
We're delighted to have you today. I've wanted to have you as a guest for a long time. That's quite a work bio you've got there. But you know, we want to know what happened before technical analysis. What did you study in school? Where'd you go to school? And most importantly, how did you make a transition from school to technical analysis? Can you help us?
Good questions. Started back in college at the University of New York at Albany, looking at markets, and actually had a friend who helped me get a summer job on the floor of the New York Mercantile Exchange. And it's there where I was first exposed to markets at a really deep level, and of course technical analysis. The guy standing next to me was charting boneless beef futures. I had no idea what he was doing, and he started showing me, and before you know it, I was charting myself.
And how did you go about becoming a technical analyst? What did you do to study? I mean, these days, of course, we can go to the MTA website and get a whole list of books to follow, but I'm betting back then you didn't have that option.
Nope. It was really mostly self-taught. I got to tell you, Ed, that I probably grabbed some book. In fact, I think Larry Williams' book on how I made $1 million trading commodities might have been the first book I ever read, just kind of on the subject, and it got me much more interested in the markets. And then just literally working on the floor of the exchange and having this guy next to me to show me some stuff got me, I would say, started on my way. And throughout the bulk of my career, it was mostly self-taught, certainly until probably the mid-1990s. At that point, I had also started learning Japanese cloud charts and the work of Tom DeMark. And that kind of just helped expand upon much of my own basis of looking at the markets from counter-trend perspective, and gave me some better tools to use in addition to what I had already been working with, and that's kind of how it all evolved.
I see. Well, let's wrap this portion up by asking you, who would you say have been your greatest influences, or perhaps what books have influenced you most? You know, whatever it might be.
I guess if I had to pick one single source, I would say it was Tom DeMark and his work. He and I had worked rather closely in the mid-1990s, and at that point we were speaking almost daily and kind of consulting with each other, and I certainly learned a lot more from Tom than he learned from me. But it was a very good give-and-take relationship, and that helped really solidify much of how I look at the market now. But it's, you know, Tom's models are terrific, but they're certainly not the only way I look at the market. So, but for sure he was a big influence.
Well, we're going to get into that in a moment, but before we do, let's stay in chronological order here. Tell us about your roles at Morgan Stanley. Actually, tell us how you went from, how did it happen that you got from trading as a broker on the futures exchanges to a position at Morgan Stanley, and then take us through what you did there, what your day looked like, and then perhaps you can even transition on to what's going on at Execution Noble today. I know you just got back from Europe.
Okay. Well, back in those days, I was trading on the floor of the commodities exchange in New York for about a dozen years, but as my years went on down there, I kind of knew I didn't want to make a lifelong career trading on the floor. I had seen lots and lots of people who were well into the 40s, 50s, and even 60s trading on the floor, and just from a combination of stress level and kind of also essentially working on your own every day, even though you're with a bunch of people yelling, screaming your guts out. You're really independent. And I just realized for me, I'm much happier working in a group situation and also with some, just fair to say, less stress of trading every day, my own account, which for the first 6 years or so, I was on the floor. I was a floor broker for Prudential Beach back then in the stock index futures bid. And after the crash in '87, I decided if there was ever time to go out on my own and be a local, that was a good time, as volumes had dried up, especially on the New York Composite Index futures, what I had been trading. And I traded some. I still traded on the knife. I leased seats on Comex and coffee, sugar, and cocoa, and stayed down there several more years. But as time went on, I realized I didn't want to stay down there, but let me tell you, it's no easy feat going from trading floor environment to corporation, let alone a company like Morgan Stanley. But I had essentially set up several firms that I think kind of the top 4 firms on the street at the time that I was trying to get to. And it was Goldman Sachs, Morgan Stanley, Merrill Lynch, and J.P. Morgan. And just tried to woo some people who I had made some contact with. And at one point, a guy at Morgan Stanley called me up and said, "Are you still looking to get off the floor?" And I said, "Sure." And he says, "Come on in. I think I have the right fit for you." And somebody had left there, and they were looking to fill the senior role on the commodities execution desk. And that's how I got to Morgan Stanley. Spent a few years there, then actually went on to Bloomberg to create the technical analysis package, or better said, I mean, it existed, but redesign it to make it much more modern and usable. And the basis for what a couple 100,000 people use each day now on the Bloomberg system throughout the world, I essentially designed. And then in 2000, I had an opportunity to go back to Morgan Stanley in the equity research department as a technical analyst, and within a couple years was made chief technical strategist of the firm, and then ultimately chief market strategist.
How many people does, or at that time, did Morgan Stanley have involved with technical analysis in total? Back
then, when I went back in 2000, there were 4 of us in equity research. There are now currently no people, as far as I know.
No people.
There's no people in technical research that are formally technicians. There is one gentleman who is in the foreign exchange department whose role has now expanded to being that there's nobody else. He looks at foreign exchange plus gold and stock indexes and basically anything else, but it's not official research for the firm. It's more a desk strategist.
As a veteran of the corporate wars, how do you explain that? You know, it seems like just at the very time that these firms need technicians, it started with Louise Yamada getting cut a few years ago at Smith Barney. You tell me that there's nobody left at Morgan Stanley. I suspect that's indicative of the rest of the street. What do you got to say about that?
Well, I think the research model on the street has changed dramatically in the last few years, and research departments have been cut quite a bit. But typically, and I'll give you an example, at Morgan Stanley, when there was some change of guard as far as the head of the equity research department, when a new guy came in, he had lunch with each one of kind of the sector heads and myself and some of the head strategists. And in these individual lunches, it was just a chance to get to know each other. And when I had my lunch with him, he said, specifically as far as technical analysis, not something he personally believed in, but he knows people do, and therefore, he thought it'd be an important thing to have. But as time went on and budgets got cut, etc., it's often one of the first things to go because most people are fundamentally oriented, and they think that valuing a company from a fundamental perspective or the market as a whole has more value than looking at charts. But I think most of us who are been around the charting side for long enough know that you're looking at a fraction of the puzzle if you're only looking fundamentally. And
could that also be because technicians aren't bringing in any investment banking business?
Well, that's a part of it. It's much more difficult to quantify any type strategist role as compared to somebody who has direct relations that do bring in investment banking. But as time goes on, too, that's an issue that even loses some of its value in the current I'd say equity research structure the way things are now, because just as they try to separate more and more pure analytical roles from any type banking roles, that even kind of has less of a say these days. It's just, look, in general, most administrators are not people who come from trading desks and not people who use technical analysis, and therefore it's just not high up on their scale of have-tos. So when heads need to roll, that's a place that often they'll take from. It's unfortunate, but it's the reality.
Yeah. Let's go on here, and let's move into a portion of our podcast interview we call the Toolbox, where we try and dig in and find out what tools our guests are using. Now, it's well known, I think you already mentioned, that you are a big user of cloud charts and DeMark Indicators. We've already had two guests, Katie Stockton at MKM Partners, as well as Nicole Elliott at Mizuho in London, who are big users of cloud charts. And so I thought maybe today we could just zero in on DeMark Indicators. And now that you've explained you've had a personal relationship with him, I'm more excited about this than ever. DeMark Indicators, in my simple way of thinking, are very complicated. Let's start out with this. How would Melanie Griffith have explained DeMark Indicators on that famous elevator ride in Working Girl? In other words, in 30 seconds, how do you explain to somebody what they are?
Well, she probably would not have done it very well.
Yeah.
But given 30 seconds, the way of looking. Look, first of all, he's got a ton of different indicators, so there's no way that you can put them all into one bucket. But the ones that he's probably most well known for are models that are counter-trend models, and they look to define exhaustion points of trends versus defining the trends themselves. And most technicians, by almost textbook definition, look to define trends for the purpose of exploiting the trend. And what I do mostly is look to find the exhaustion points of trends, thinking that to maximize performance for a portfolio manager, the only way he has a good chance of outperforming a benchmark is to actually selling stocks near real highs and buy them near real lows. And by and large, most portfolio managers miss the top and bottom 15 to 20% of the entire moves, and they play in the fat part of the bell curve. And to me, that's a very difficult place to outperform. But if you can actually sell stuff near the highs and buy near the lows, you have a much better chance of outperforming. So many years ago, I realized that to differentiate myself on the street from the average trend-following technician, I needed to do and approach the markets differently to really make my own name and reputation. And that's where, back in the late 80s and early 90s, I started working on counter-trend models and looking at the markets that way.
Okay. We're going to continue with Rick Bensignor in a moment, but first a reminder that on July 13th, we'll have the Chief Technical Analyst at Thomson Reuters, Jeff Chia, as our guest. And then on July 20th, from Barron's, Mike Santoli will join us. Rick, this statement of yours I'm going to read is probably dated by now. As a matter of fact, I know it is as of this morning's note. But I'd like to ask you about it. We'll use it as some fodder to get started here. Quote, in the bigger strategic picture, we lean more bearishly than bullishly, and thus getting a setup +9 count tomorrow. For those of us who aren't familiar with DeMark Indicators, what does this mean? What other setup should we be familiar with? Just give us enough to be dangerous here.
Yeah, so one of the basic elements to looking for exhaustion of trend is first identifying that trend even exists in the first place, because you can't exhaust a trend until you know there's one that exists. And one of the things Tom put together many years ago is something called a TD setup, which is a piece of this whole bigger model called sequential, looking for exhaustion of trend. And basically, if a stock starts moving upward, it's looking for 9 consecutive price bars in whatever time frame you're looking, that the closing price is greater than the close from 4 bars earlier. And when you get to the 9th bar, you at least are at a pivotal point to either say, if we go beyond this, you probably have trend, and if not, this is all you go, and the market will turn around and go either sideways to down. And specifically, yesterday in the S&P 500, the NASDAQ, and the Russell 2000 came into the day, and where futures were trading earlier in the day, they were all on +8 counts, meaning yesterday was the 8th consecutive day that the close was above the close from 4 days prior. But by the time the market closed yesterday, those 3 indexes actually closed beneath their close from 4 days prior, killing those setup counts. We were looking for, hopefully, to get a 9th bar today, in which case we'd have potentially a short-term high in the market, and we would look to fade that, because in our bigger context, we're looking for the market to go down significantly over the next several months. And therefore, any type of short-term upside exhaustion would be used as a potential catalyst to position short for the bigger down move.
Okay, you made a yeoman's effort to explain that, but already I'm confused, because I thought you said the setup was trying to find the trend, so I was assuming if you got 9 up, you had a uptrend.
It's 9 up is typically the pivot point between going beyond there to actually define some trend, or it's all you go. So often guys who know this model will look for 9 consecutive bars closed above the close from 4 back, or 9 consecutive bars closed less than the close from 4 back in order to do some buying, and potentially look for a near-term flipping point.
All right. How about for guys like me? What's a good way to go about learning DeMark Indicators? Is there a good introductory text, or what would you do?
There is a friend of mine in London who's actually a technician for UBS, Jason Pearl, came out with a book probably, I'm guessing, a year and a half ago on DeMark Indicators, which was well-written and fairly simple to understand in the scheme of things, because they are fairly complex models. Tom DeMark himself has written 3 books, a little more difficult to understand, which is why I'm kind of leaning you more towards Jason's work. There's also a lot of free information on the internet. If you do a Google search for like Tom DeMark sequential, you'll find oodles written about it. And any people who are in the professional world and have access to Bloomberg have, through the Bloomberg system, all this information is available also.
Well, and that takes me to the very next line in my notes, which is, do we need a Bloomberg machine to use this, or is this something the rest of us can do with a spreadsheet, or what do you think?
Good question. As far as I know, there's only 3 vendors who have access to these models that are officially sanctioned by DeMark's company. That would be Bloomberg, Thomson, and CQG. So those are the only places you can get the models and essentially subscribe to them and have all the mathematics show up on your charts. You can do some of this on your own, certainly the setup portion. So if you could use an Excel spreadsheet and program it to monitor stocks that have this pattern of 9 consecutive closes above the close from 4 bars back, or vice versa, 9 consecutive closes less than the close from 4 bars back, that at least can get you the setup portion of the model, the countdown, the further step that gets you to ultimately look for the exhaustion points of a model is a little more complex. And although the rules are stated in his book, so it's not as if it is private information or something proprietary. It's something you can attempt to model yourself. Most people who have can get some of the basics down, but there are a lot of nuances and things to this that, without getting his official sanctioning, which, as I say, only 3 companies have gotten, it's pretty difficult to do this at the same accuracy level as these sanctioned products.
Right. Rick, we are out of time, but I can't let you go without getting your views on the market. You, in the opening quote, I made it clear that your views are we're going to go below 1,000 on the S&P, and yet now that I hear your explanation of DeMark Indicators, I'm going to go out on a limb and say you didn't come to that conclusion from DeMark Indicators. What are you looking at?
Well, some of it actually, it's more based on long-term cloud charts, but Tom's work did have, up on the highs this year, the S&P had a sequential sell signal on the weekly chart. So it did somewhat coincide with the highs this year, did somewhat coincide with an exhaustion point on Tom's work. And so it's really kind of a combination of both, but it's really more from long-term cloud charts that I suspect we have more room to go on the downside. We could meander here for a while. You've got to get futures to close back under 1065 and whatever the front month futures are on a weekly basis to really get the breakdown. Some caution flags will go up if the Russell on a daily basis gets under 625 and especially under 617. The Russell is the last of the major indexes not to have structurally broken its bullish bias, and if it were to do that at this point and break under those levels, then I do think there's a good solid move coming on the downside that in S&P terms breaks under 1,000 and probably could get you as low as 950.
Okay, all right. And just forgive me, but a yes or no question. Are you using cloud charts to set price targets? Is that what you're doing?
Yes. It is one of many ways I look at price targets. And let me just say, Ed, that one of the things that I've looked to do for many, many years over the bulk of my career is, instead of getting too set on any one model, I love to use lots of models that have nothing to do with each other. And when they get confluent areas on a chart that potentially act as support or resistance, those give me much more confidence that those levels can work and hold, because they come from models that have nothing to do with each other, and if they're all kind of pointing to the same general neighborhood, I have much more confidence than if I looked at an RSI, a stochastics, a Williams percent R, which are 3 different ways of almost doing the same thing, so they almost always say the same thing, and therefore you don't really get different news from them. The best for me is taking something like DeMark's work, cloud charts, some other proprietary models I came up with myself, maybe throw in some Fibonacci retracements, and if they all happen to come together, that's where I'm going to target bigger moves to get to.
Yeah. Rick, thanks so much for joining us today. I can tell you're having a busy day just from the sound in the background. Is there anything else you'd like to share with us before we conclude today? For listeners, technical analysis is the type of thing that I think as technicians, we tend to think that we have far better tools than fundamental analysts. And given the choice of one or the other, I myself clearly lean towards and virtually do everything from the technical side. But it's also, as much as it's fundamental analysts who look at technicians and say, oh, what you guys do is kind of, out there voodoo stuff, it would be foolish for technicians to think the same of fundamental research. And, the bottom line here is you need to look at both pieces of the puzzle along with truly understanding some behavioral economics and finance to get a really well-rounded picture of what's going on in the markets. Yeah, well said, well said. Today's guest has been Rick Bensignor of Execution Noble, and that wraps up today's MTA Podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson with our engineer Shane Squark, who is somewhere in a recording studio deep in the bowels of the MTA's World Domination headquarters in New York City. Say goodbye, Shane.
So long, everybody.
Let's keep our stops tight. Good day.